All right, folks, welcome back to another lecture in our CFA Level 1 journey. Today, we're going to explore something absolutely foundational: equity securities. Whether you're trading stocks, analyzing portfolios, or just trying to sound smart at dinner parties, understanding equity securities is crucial. So, let's unpack what they are, why they matter, and how they shape the entire investment landscape. Now imagine this: you're a part owner in a business. Let's say your cousin opens up a trendy coffee shop downtown and you invest in it. You don't lend her the money, you buy in. That's equity. You now own a slice of that business. You're not just hoping it succeeds, you're riding with it. That's what equity securities are all about: ownership. Equity securities represent partial ownership of a corporation. As an owner, you get certain rights: voting rights, maybe a cut of the profits through dividends, and the potential to benefit when the company grows and becomes more valuable. In fact, for many investors, both individuals and big institutions, equity forms a major part of their portfolios because of the growth potential. But here's the thing: with that ownership comes higher risk. Unlike government bonds, where you know what you're getting, equity securities can swing wildly. Think about Tesla stock. One tweet from Elon Musk and bam, the price moves like it's on a roller coaster. That volatility is what makes equity both exciting and a little terrifying. Because of that risk-return trade-off, equities are considered a key asset class. They tend to offer higher returns than safer assets like T-bills, but they come with higher uncertainty. That's why your allocation to equities and what types of equities you own has a huge impact on your overall portfolio performance. One cool way analysts gauge whether equity markets are fairly priced is by comparing the equity market capitalization to GDP. Let's take the US market when the market cap of all stocks is way higher than the country's GDP, like we saw before the dot-com bust. That's often a red flag. Conversely, if the ratio is below historical averages, markets might be undervalued. It's not foolproof, but it gives you a bird's eye view. Here's how you calculate it. Market cap of a stock is just the share price times the number of shares outstanding. So if Tesla's trading at $1,000 and there are 1 million shares out there, the market cap is 1 billion. Total market cap of an entire exchange or country. Just add up the market caps of every listed company. And if you want to know how active the market is, you look at trading volume, which is basically the average share price multiplied by how many shares were traded that day. Before we dive into the different types of equity, let me give a quick shout out to FinQuiz. If you're finding these concepts a little heavy, and let's be honest, CFA content isn't exactly beach reading, check out the FinQuiz Smart Summaries available in the description. These visual summaries make concepts click, and they're backed by formula sheets, a huge question bank, and mock exams that feel just like the real thing. If you're serious about passing, give yourself every advantage. Now, let's move on and dig into the actual characteristics of equity securities. We'll look at how equity compares to debt, what types of equity exist, and how features like voting rights and dividends play into valuation. So picture this: a company needs money. It has two options: borrow it, debt, or sell a piece of itself, equity. When a company issues bonds, it's borrowing money and agrees to pay interest. If it issues shares, it's giving you a slice of ownership. Now, if you're holding debt, you're the lender. You get fixed interest payments and expect to get your money back. But if you're holding equity, you're on a different ride. You don't have a guaranteed payout, but you have a shot at big upside if the company does well. This brings us to the two big buckets of equity: common shares and preferred shares. Let's start with common shares. When you hear someone say, "I bought Apple stock," they're talking about common shares. These represent real ownership. You get a vote in the company usually once a year, and you might get dividends if the company decides to pay them, but nothing is guaranteed. Also, in case of liquidation, if the company goes under, you're last in line. After all, the bondholders and preferred shareholders get their share, whatever's left, if anything, goes to the common shareholders. It's like being at the end of the buffet line. You might get dessert, or you might just get an empty tray. Common shareholders also have voting rights. Now, most of us aren't flying out to attend shareholder meetings, which is why we vote by proxy. That just means you assign your vote to someone else, usually management or a representative, to vote on your behalf. And yes, companies can issue different classes of common shares with different levels of voting power. Think of Google's parent company, Alphabet. They've got Class A, B, and C shares, some with votes, some without. This way, founders can raise money without giving up control. Speaking of voting, there are two systems you need to know: statutory voting and cumulative voting. In statutory voting, you spread your votes evenly. Let's say you have 100 shares and there are 5 board seats. You get 100 votes per seat. In cumulative voting, you multiply your shares by the number of seats. So 100 shares times 5 seats equals 500 votes. You can throw all 500 behind one candidate if you want. That gives minority shareholders more say. Now, here's where things get spicy: callable and putable common shares. A callable share lets the company buy it back from you at a set price. They'll usually do this when the market price is higher than the call price. It's a way for companies to save on dividends or manage their capital structure. On the other hand, a putable share lets you, the investor, sell the share back to the company at a set price. That's your safety net if things go south. All right, let's switch gears and talk about preferred shares. Now, I know what you're thinking. Preferred shares? Isn't that just a boring version of equity with a bow tie on it? Well, not quite. Preferred shares are like the middle child between equity and debt. A bit conservative like bonds, a bit rebellious like stocks, and surprisingly important when it comes to understanding capital structure. These are like the quiet cousin of common shares. They don't usually come with voting rights, but they get priority when it comes to dividends and liquidation. Preferred shares are basically like VIP passes to a company's profits. You get paid dividends before common shareholders, and if the company is going down the tubes, you'll be higher in the pecking order when assets are handed out. But don't get too excited. You're still behind bondholders in liquidation. So yeah, not that VIP. Think of it like preferred shareholders are first in line at the buffet, but they don't get to vote on what's being served. Preferred shares pay fixed dividends, so they're more stable, kind of like bonds. They're great for income-focused investors who want more reliability and less drama. You'll see a lot of preferred stock issued by banks and utilities. Let's say Tesla issues preferred shares. They don't want to dilute Elon's voting power too much, but they want to raise capital. Boom. Preferred shares, no voting rights, steady dividends, and they can call them back later when their stock price shoots up. On the other hand, a startup might offer participating preferred shares to private equity investors. These shares not only get a fixed dividend, but they also get a slice of the profits after common shareholders. That's a win-win for VC firms looking for upside and downside protection. Now, preferred shares come in many flavors. First up, cumulative preferreds. If the company skips a dividend, they still owe it to you later. That skipped dividend accumulates and must be paid before common shareholders get anything. And then non-cumulative, if they skip the dividend, it's gone. You don't get it later. Tough luck. Kind of like, you snooze, you lose. Missed dividends are gone. Poof. These are more common with riskier companies who can't promise consistent cash flows. Participating preferreds, Now, if the company makes more profit than expected, you could get extra dividends. And in liquidation, you might get more than just the par value. Think of it like you get your guaranteed cupcake, but if there's cake left over, you get an extra slice. Nice. Now, non-participating, it's like you get your cupcake and that's it, no matter how big the cake is. These are cheaper for the company to issue, so you'll often see them in smaller, riskier firms. Now, this one's a fan favorite. Convertible preferreds give you the option to convert into common shares. The conversion ratio tells you how many common shares you'll get per preferred. This is like having a golden ticket. If the company's stock price rockets, you convert and ride the wave. If it doesn't, no worries. You still get your dividend. Think of early stage Amazon. Investors had convertible preferreds. When the stock took off, they converted and became very rich common shareholders. Smart move, right? So guys, remember, convertible preferreds can be turned into common shares. So you start with steady income, but if the company booms, you can convert and ride the wave. Now, why do investors love convertible preferreds so much? Simple. They get the best of both worlds. You enjoy higher dividends than common shareholders. Hello, steady income. But you've also got a secret weapon in your back pocket, the option to convert if the company takes off. That means if the stock price goes to the moon, you don't just sit there watching, you jump on the rocket by converting your shares. Plus, they're less volatile than common stocks, so your ride's a little smoother. No wonder venture capitalists and private equity pros go for these. They want downside protection and upside potential. It's like having both an umbrella and sunglasses in one, ready for any weather. All right, now that we've talked about equity from a public market perspective, Apple, Microsoft, all that good stuff, let's switch gears and talk about a world that's a bit more behind the scenes, private equity. Now, when you hear the words private equity, your mind might jump to suits in glass towers buying billion-dollar companies. But let me tell you, there's more to it than just big deals. At its core, private equity is just ownership in companies that aren't listed on a public stock exchange. No tickers, no trading apps, no CNBC headlines. These are companies raising capital quietly, often through private placements, where shares are sold directly to investors, usually big players like institutional funds, high net worth individuals, or private equity firms. Now, here's the thing. Private equity comes with its own trade-offs. First, it's illiquid. That means you can't just sell your shares whenever you want. There's no market price popping up on your screen every 2 seconds. The valuation? It's usually negotiated privately. Think Shark Tank, but with a lot more paperwork. Because of this, it's harder to raise capital in private markets. But on the flip side, these companies avoid the costs of regulatory filings, financial disclosures, and all the scrutiny that public companies have to deal with. And here's something cool. The holding period for private equity investments has gotten longer. What used to be a 3 to 5 year play has now stretched to 8 to 10 years. Why? Because it gives investors more time to fix operational issues, drive growth, and create long-term value. Let's talk types. You probably heard of venture capital, and that's a form of private equity. It's all about funding early stage startups. Think seed money for a new fintech app, or Series A for a biotech startup. These investments are high risk, high reward, and the exit strategy is usually an IPO or a sale to a bigger player. Then we've got leverage buyouts, or LBOs. This is when a group of investors buys out a company using mostly borrowed money. The company's own assets are used as collateral. Picture buying a house with a mortgage, but instead of a house, it's a software company with $100 million in annual revenue. After the buyout, the company is no longer public. It's taken private. Then the goal is to make it leaner, more profitable, and eventually relist it or sell it for a profit. There's also management buyouts or MBOs. That's when the company's own executives buy the business. They already know the company inside out, so it's a natural fit. And one more category to know, PIPEs, private investment in public equity. This is when a public company sells shares to private investors at a discount, often because they need to raise funds quickly. The bigger the rush, the deeper the discount. Now, let's contrast all this with public equity. That's the world we all know. Stocks listed on exchanges, transparent prices, liquidity, and strict regulatory rules. You can buy or sell shares instantly. Information is public, valuations are visible, and the price you see is the price you get. But just because public equity is more accessible doesn't mean it's always better. Private equity offers long-term value creation, operational control, and the chance to unlock hidden value. Public equity gives you liquidity and transparency. Think of it this way. Investing in public equity is like dating with a dating app. Instant access, lots of choices, but surface level. Private equity, that's more like a long-term relationship. Takes work, takes time, but the payoff, it could be much greater. All right, in the next section, we're going global. We're going to explore non-domestic equity securities, how you can invest in companies overseas, what are depository receipts, and what happens when you want to own a slice of a company listed on a totally different continent. Okay, let's get started. It's time to take things international, because believe it or not, owning shares in Nestle, Samsung, or Alibaba doesn't mean booking a flight to Switzerland, Korea, or China. Thanks to global investing tools, you can access foreign companies with a click. So we are going to explore non-domestic equity securities. That means investing in companies outside your home country. Now, first off, why go global at all? The simple answer is diversification. Different markets move in different ways. So when US tech stocks are crashing, maybe Indian pharma or Brazilian energy is booming. Adding non-domestic equity to your portfolio spreads your risk and can smooth out returns. From a company's point of view, listing shares on foreign exchanges opens the door to more capital and visibility. For example, when a German company lists in the US, suddenly millions of American investors are aware of its brand, boosting both liquidity and legitimacy. It also pushes them to improve governance because now they're under more global scrutiny. So for companies, foreign listings open up access to more capital and new customers. A classic example, Alibaba, a Chinese tech titan, chose to list on the New York Stock Exchange back in 2014. Why? To access deep US capital markets, boost global brand visibility, and diversify its investor base. But it's not always easy. Many countries impose foreign ownership restrictions. These rules are designed to protect national interests, basically to prevent too much foreign control. You'll see this a lot in industries like banking, energy, or defense. Governments may also want to ensure that locals benefit from companies operating on their turf. Still, the long-term trend? More openness. As markets mature, countries tend to ease restrictions to attract foreign capital. All right, so how do you actually invest abroad? Let's start with direct investing. That means buying shares of a foreign company on its home exchange using local currency. So if you want to buy shares of a Japanese tech company, you'd go to the Tokyo Stock Exchange, pay in yen, and deal with local rules, taxes, and settlement systems. So this is the do-it-yourself approach. You literally buy shares on a foreign exchange using the local currency. It sounds adventurous, right? But here's the catch. You need to understand the local market's rules, systems, and even tax implications. Let's say you're sitting in Canada and decide to buy shares of Toyota directly on the Tokyo Stock Exchange. You'll need Japanese yen, a brokerage that gives you access to Japanese markets, and probably a strong cup of coffee to deal with time zone differences. Also, direct investing may come with lower liquidity and transparency, especially in emerging markets. Think about trying to sell your shares in a small Vietnamese construction firm. You might be stuck waiting for a buyer. Sounds messy, right? That's why most investors go for indirect investing. This is where depository receipts, also called DRs, come in. These are tradable securities that represent shares in a foreign company but are bought and sold like regular local stocks. With DRs, you can invest in foreign companies without ever leaving your home market. We'll get into more details in a second, but think of them like international stocks translated into your local language. You get exposure to the foreign company, but in your own currency and market. Some countries don't want foreign investors owning too much of their local companies. Why? A few reasons, like control limits. Think of strategic sectors like defense or telecom. A country might say, we want these under local control. Governments might want citizens to benefit from homegrown businesses. Now, if too much hot foreign money comes in and out, it can mess with a market's stability. But over the long term, even countries like India have eased some of these restrictions to attract more foreign capital and boost development. Now let's discuss the types of DRs. Let's break them down. GDRs, Global Depository Receipts, are issued outside the company's home country and outside the US. They're often priced in US dollars and can be listed in multiple countries at once. They're usually placed with institutional investors. Think of them as the global passport for equity investing. For example, a Brazilian mining company might issue GDRs in London or Luxembourg. These are mostly traded in USD and are often targeted at institutional investors. Neat example? Gazprom, the Russian energy giant, has used GDRs to raise money outside Russia, tapping into European investors. ADRs, American Depository Receipts, are issued by U.S. banks and trade on U.S. exchanges. They let American investors buy into foreign companies without leaving their domestic market. For example, if you've ever seen Alibaba, Baidu, or Toyota traded in New York, that's an ADR. Similarly, companies like Samsung, Unilever, and Tencent all have ADRs in the US. Let's say you're bullish on Sony, but you don't want to mess with Japanese yen. You can buy Sony's ADR in USD on the NYSE. It's just like buying Apple. Each ADR is backed by actual shares held by a US custodian bank. So even though you're holding the receipt, you indirectly own the foreign stock. There are 3 levels of ADRs. Level 1 trades over the counter, isn't listed, and involves minimal reporting, no capital raised. Level 2 is listed on exchanges like New York Stock Exchange or NASDAQ, but still only trades existing shares. Level 3 is the big one, listed, fully registered, and allows the foreign company to raise capital in the US. Tata Motors from India has a Level 2 ADR that trades on the NYSE. When it wanted to raise capital, it went with a Level 3 ADR to gain access to US investors and expand its global footprint. Then you've got Rule 144A ADRs. These are private placements to qualified US institutional buyers. No public trading, but they're faster and cheaper to issue. There's also something called a Global Registered Share, GRs. Unlike DRs, these are actual shares that trade globally in multiple currencies. So if you buy a GRS, you own the real thing, not just a receipt. It gives even more flexibility since you don't have to worry about exchange rate conversions when trading across borders. For example, Royal Dutch Shell had shares that were structured this way so they could be traded both in London and Amsterdam with minimal hassle. GRS are more flexible than ADRs since there's no need for currency conversion or separate listings. And if you're into ETFs, you'll like this. BLDRs, or Basket of Listed Depository Receipts, are ETFs made up of multiple DRs. One popular example is the Asia 50 ADR Index Fund, which tracks top Asian companies trading in the US. Think of it as a sampler platter of Asian blue chips. Now, just a heads up, investing globally means your total return isn't just price gains and dividends. You've also got foreign exchange risk. So if you buy a German stock and the euro drops versus the dollar, even if the stock price rises in euros, your dollar return might fall. That said, these foreign equity investments can be incredibly powerful tools for both growth and diversification, especially for long-term investors. And all of this, yup, you guessed it, it's neatly summarized for you in our FinQuiz Battle Ready Summaries. We've turned all these international terms and distinctions into clean visual notes to help you study faster and smarter. You'll also find matching questions in our FinQuiz question bank, which walks you through real CFA style exam problems to test your grasp on this stuff. So go ahead and check them out on their official website. You've made it this far, which means we're ready to talk about one of the most important and most tested topics: risk and return characteristics of equity securities. We'll break down risk and return characteristics because not all shares are created equal, and how they behave under pressure can make or break your portfolio. Let's keep it simple. When we talk about equity returns, there are two main sources. Number one is price appreciation. That's when the stock price goes up over time. You buy low, sell high. Easy in theory, right? And second is dividend income. That's the cash the company pays you, usually every quarter. That's the company sharing its profits with you, the shareholder. So in CFA language, the formula for total return looks like this. What's the change in price plus any dividends divided by the price you originally paid? In plain English, it's the capital gain, which is price now minus price before, plus the dividend you got, all divided by the price you originally paid. That gives you a nice percentage return. Now, if a stock doesn't pay dividends, then your return is just from price appreciation. Let's look at real companies. A stock like Apple might give you both, a price that moves and dividends every quarter. But a growth company like Netflix, they usually reinvest their earnings, so your return comes mostly from stock price growth. But if you're investing in foreign stocks, say through an ADR or buying directly in a foreign exchange, you add one more thing to that return: foreign exchange gains or losses. Let's say you buy shares in a European firm and the euro strengthens against your local currency. You'll get a boost in returns. But if the euro weakens, your dollar returns take a hit, even if the stock price in euros goes up. And let's not forget the magic of reinvesting dividends. Over time, compounding reinvested dividends can massively boost your returns. That's how Warren Buffett built Berkshire Hathaway. He reinvested, reinvested, reinvested. Those can supercharge your long-term returns, especially with compounding. Just ask anyone who's held Apple and reinvested their dividends for the past 20 years. Now let's talk about risk, because where there's return, there's risk. Equity securities are inherently more volatile than bonds or cash. There's no guarantee a company will pay you dividends, or if it does, there's no guarantee it'll keep doing it. And the stock price? It can move on earnings, rumors, interest rate changes, or even a CEO's tweet though. Just ask Elon Musk Now, higher uncertainty means higher expected return, which means more volatility. Risk here refers to the uncertainty of expected return. You don't know what price you'll sell for or whether you'll even receive dividends. The more uncertain a stock's cash flows, the riskier it is. We measure that risk using standard deviation, a fancy way of saying how much the returns tend to move away from the average. That's why tech stocks often have higher standard deviation than utility stocks. There are two ways to estimate it. You can use historical data to calculate the average return and its variability. Or you can use expected future returns, which is more of a forecast based on assumptions. Now here's something CFA wants you to know. Not all equities carry the same level of risk. Take preferred shares. They usually pay fixed dividends, kind of like bonds. They're more stable. That's why they're less risky than common shares. Preferred shares are like that reliable friend who always shows up on time. They pay fixed dividends like clockwork. And if a company goes bankrupt, preferred shareholders get paid before common shareholders. Think of it as the VIP line in liquidation. Bank of America's preferred shares, they behave more like a bond. Steady income, lower risk. And among preferreds, cumulative preferred shares are less risky than non-cumulative because missed dividends get paid later. Now compare that to common shares, where the return depends on the company's profits and the market's mood. They're the last in line during bankruptcy, and their dividends aren't guaranteed. But they do have more upside if the company thrives. Puttable shares are safer because if things go south, you can sell them back to the company at a set price. It's like having an insurance policy. That limits your losses and lowers your risk. But there's a trade-off, lower dividends. Callable shares are riskier for you because the company can take them back when it's convenient for them, usually when the price is up. That's because callable shares give the company the right to buy back the shares if the price gets too high. That caps your upside. So naturally, investors demand a higher yield to make it worthwhile. Some preferred shares issued by financial firms come with this callable feature, meaning if rates drop, the company can refinance and call back the shares, just like a mortgage. So as an investor, puttable shares are lower in risk and therefore offer lower return. Callable shares, higher risk, higher return. Makes sense, right? If a dividend is cumulative and the company skips a payment, it still owes you that money. Missed dividends accumulate and must be paid before common shareholders get anything. Non-cumulative, no such luck. If they miss a dividend, too bad, so sad. Now that we've got a grip on risk and return, it's time to zoom out and look at the big picture, how equity ties into company value, and how businesses use it to raise capital, grow, and boost shareholder wealth. Let's kick it off with this. Why do companies issue equity securities in the first place? Well, think about any growing business. You need money to grow. Companies raise equity capital to fund operations, buy equipment, build factories, acquire competitors, invest in R&D, expand into new regions, or even pay employee stock bonuses. Equity is the lifeblood that fuels all these big-ticket strategies. Well, equity isn't just some abstract number on a balance sheet. It's a company's way of raising money for things like launching new products, expanding into new markets, acquiring other businesses, or even just keeping the lights on. Take Netflix, for example. They've raised billions by issuing equity to fund their original content strategy. Without that cash, Stranger Things might not even exist. Or think of Facebook's acquisition of Instagram. It wasn't a cash deal. It was mostly done using Facebook stock. Even employee compensation can be a reason. Companies like Google use equity-based stock plans to attract and retain top talent. Why pay cash when you can pay in future millions, right? Unlike debt, equity doesn't require fixed repayments. So there's no pressure to pay interest every month, which gives businesses breathing room. But here's the trade-off. Equity dilutes ownership. When a company issues more shares, it's splitting the pie into smaller slices. So if a company's raising equity capital, it better be using that money to generate enough return to justify it. So what's the end game? Why go through the hassle of issuing equity? Simple. The goal is to increase shareholder wealth. Companies want to maximize the book value and, more importantly, the market value of their equity. Now remember, book value is based on accounting numbers. It's historical. But market value, that's based on what investors think the company is worth based on its future. That's why Tesla's market value went through the roof. Even when their book value was still catching up, investors were betting on Elon's vision. So, folks, book value is the accounting number. It's basically total assets minus total liabilities. It reflects past decisions, what the company has earned, retained, and reinvested. And it's something the management team has direct control over. More net income means more retained earnings, which means higher book value. Now contrast that with market value. This is what investors in the open market think the company is worth based on expectations of future cash flows. It's not about the past. It's about the story investors are buying into. Here's a quick way to remember the difference. Book value is what the company has done. Market value is what the market thinks it'll do. And speaking of market value, let's talk about one of the most common valuation ratios, price to book. If the price to book ratio is high, that means investors expect strong growth. You'll see this in tech or biotech industries where innovation is everything. But a low price to book, that could mean the company's mature, like a utility or an insurance firm where growth is steady but not spectacular. You'll often hear investors compare the two using the price to book ratio. A high price to book ratio, that means investors expect strong future growth. A low price to book, either the stock is undervalued or the market's lost confidence. Just be careful, you can't compare price to book ratios across industries. A heavy equipment company will naturally have lower PB ratios than a fast-growing tech firm. Now let's bring in one of the CFA exam's favorites, return on equity, or ROE. ROE is your go-to metric for evaluating how efficiently a company is using its equity capital. This tells you how well a company is using shareholder money to generate profits. It answers the question, if I give this company $1 of equity, how much profit will it generate in return? The formula is simple, net income divided by book value of equity, and you can calculate it using either the beginning value or the average, depending on whether the company's equity is stable or volatile. For example, if you're analyzing a stable giant like PepsiCo, beginning value might work, but if you're dealing with a more volatile company, say Snapchat, then average equity gives a better picture. This version averages the beginning and ending equity over the year, especially useful when equity fluctuates a lot during the year. Let's say a company has $1 million in net income and $3 million in equity. That's an ROE of 33%. That means for every dollar of equity invested, the company generated 33 cents of profit. But here's a trick. You can make ROE look higher by taking on more debt and reducing equity. That's why it's important to understand how ROE is changing. If net income is rising faster than equity, great. But if the company is just loading up on debt to boost ROE, that's a red flag. And when you want to really analyze what's driving changes in ROE, that's where the DuPont formula comes in. We'll hit that in detail in the valuation module. Now, what about the cost of equity? The cost of equity is the minimum return that investors expect for taking on the risk of owning shares. If a company wants to attract investors, it needs to provide that minimum expected return. Otherwise, investors will walk. This expected return can be estimated using models like the dividend discount model, DDM, or the capital asset pricing model. Use DDM for dividend-paying stocks like Coca-Cola and CAPM for growth companies like Meta that reinvest instead of paying dividends. And here's something interesting. The cost of equity for the company may not match the required rate of return for the investor. Why? Because of flotation costs, things like underwriting fees, legal expenses, and regulatory filings that eat into the company's proceeds. Now let's talk about what happens if the company's performance doesn't meet investor expectations. If shareholders think the company won't deliver their required return, guess what? They sell. Stock price drops. And the company's cost of equity goes up until it finds that sweet spot again. This is why managing the cost of equity is so critical for firms that want to keep investors happy and maintain their market value. So the higher the perceived risk, or the more costly it is to raise equity, the higher the return investors will demand. If the company isn't delivering that expected return, shareholders sell, prices drop, and the cost of equity rises until it balances with investor expectations again. Now combine cost of equity with cost of debt, and you get a key concept, WACC, the weighted average cost of capital. WACC tells us the minimum return a company needs to justify a project. If a new product line or factory can't beat WACC in returns, it's a no-go. Apple, for example, doesn't just build stuff because it sounds cool. They run everything through WACC and capital budgeting models first. To wrap this all together, companies aim to maximize shareholder wealth by keeping their cost of equity low and their share price high. This means being smart about when and how they issue shares. And folks, I repeat, when evaluating new projects or investments, companies use WACC, the weighted average cost of capital. It's the average rate they need to earn on investments to satisfy all capital providers, both debt and equity holders. If a company's return on a new project is higher than WACC, that's value creation. And if you're wondering how to actually calculate these values on exam day, our FinQuiz formula sheet is a game changer. It puts every key formula in one place, designed exactly the way CFA exam questions are framed. You'll find all of this explained visually in our summaries and tested thoroughly in our FinQuiz question bank and mock exams. All right, we've come a long way. From understanding equity ownership to risk, return, and how equity ties into company value. This stuff is gold for the exam, but more importantly, it's foundational for real-world investing and finance careers. If you take one thing away today, let it be this. High returns are great, but only if the risks and costs are managed smartly. All right, take a breather, let this sink in, and then do some chapter end questions and examples from the CFA Institute's official curriculum to cement the concepts. See you in the next lecture. Until then, happy studying.